Good morning, everybody. My name is Lydia Ofori. I'm CEO of Future of Partners. Welcome to our webinar, ESG Sifting Through the Masses. So we all know that ESG, particularly within the equity space, have increased over the past couple of years. I think I read some statistics in pensions and investment that over the past 4 years, equity strategies or ESG invested equity strategies, the AUM have increased up to more than $40 trillion within a short space of time. However, ESG investing have been with us for probably more than 20 years now. So today we really want to understand a few things about what have been driving the surge in ESG equities investing, but more particularly trying to understand how equity analysts are identifying the major factors within their portfolios, and also how fund selectors are combining the ESG equity portfolios to suit investors' appetite. And so today on the webinar, we have three specialists. I'm kind of as one of the four. Three specialists. I will go ahead and introduce them. We have Yeoh, who is a senior portfolio manager at RBC Global Asset Management. Ben is also a healthcare sector specialist within the firm. In addition, he is a team's ESG champion and sits in a non-executive advisory capacity for responsible investment and ESG for a leading UK investment trust. Prior to joining RBC Global Asset Management in early 2014, Ben worked in the same capacity for 3 years at First State Investments, and previous experience include roles at Atlantic Equities, where Ben was responsible for global healthcare research with a special focus on the US, and at ABN AMRO, where he was recognized with a #1 Thomson Excel rating across all sectors for integrated ESG research. In 2012, Ben won the Star Mine Award for Best Stock Picker in Healthcare. Welcome, Ben.
Thank you.
We also have Mike Sell. Mike is a head of Asian Equities and Portfolio Manager at Alquity. Alquity is one of the leading boutique companies that focus solely on ESG investing. He is responsible for all equity investments across Asia, and he's also co-portfolio manager for the global emerging market strategy. Mike has over 20 years experience investing in Asian equities. He joined Barron Asset Management as a graduate trainee in 1994, where he became a member of the Emerging Market Asset Allocation Committee. Ben then joined Thames River, which was also Nevsky Capital, where he was subsequently appointed a partner and was part of the team that grew the emerging market equity assets from approximately $150 million to more than $3.5 billion before moving to FNC with a long-only emerging market business in 2011. Mike was awarded the Piers Rowan Prize when he was at the Southampton University. Welcome, Mike.
Thank you.
And last but not the least, we have Richard Brill, who is a Chief Investment Manager at Helm Godfrey. He is responsible for managing the investment portfolios and leads the tactical allocation and fund selection for the discretionary multi-manager portfolios, which includes a responsibly managed multi-manager portfolios, which was launched in February 2020. In his role, Richard liaises with fund managers and investment houses, as well as providing advice to Helm Godfrey's advisors on specific investment queries. Prior to joining Helm Godfrey, Richard spent 3 years in the armed forces, commanding a troop on an operational tour in Afghanistan. Welcome, Richard.
Sure, thank you.
So, as I mentioned earlier on, we have seen a huge surge in ESG equities investing over the past 3 years. And I think the numbers that are being quoted by people like Pensions and Investment and Morningstar does not even include investment strategies that are not labeled as ESG equities investing. So I want to start off with you, Ben, and perhaps we're going to go around the whole panelist conversation, but I want to understand right now, let's go back a little bit over the past 10 years. What has been the evolution when it comes to ESG equity investing?
Well, I think a lot of it focuses around what, in terms of at least deep fundamental business analysis, what are the extra financial drivers of business? You know, what are the things which eventually lead to, well, think of this as the flow of things. We like stock prices to go up, or, you know, up and down. That's driven by sales, margins, and cash flow. What's driving sales, margins, and cash flow? Well, that's things like good R&D, strong corporate culture, aligned incentives, strong sustainable business models. And the things which drive that are often the extra financials of business, how you deal with your social capital, human capital, natural capital. And the issue is that there's maybe too many management teams who have over borrowed from one of those sources, and they kind of create these sort of liabilities which come back to haunt you at some time. But you also have companies which are investing in these kind of extra financial capitals, and that is what's then driving to better returns. And we've seen those material issues change over the years. You know, we weren't talking maybe so much about climate change 10 years ago. Now we're talking a lot more about the climate. And today we have issues such as things that COVID are throwing up, and issues like Black Lives Matter in terms of human capital. And so those are some of the things that businesses are grappling with.
That's very good insight. And Mike, do you have anything else to add to what Ben has just said?
I would reiterate much of what he said, actually. If you go back 25 years, most people looked at governance as part of their investment analysis. And then the E part, the environmental part, has become much more common over the last 10 years. Even somewhere like India or China, you can no longer get away with polluting the environment without being stopped and fined, which has an impact obviously on share prices as well as everything else. And the S part has really come into the fore with worker safety, customer safety with COVID. But I do feel that as E and S have gained in importance, we've seen the G bit drop. And I think people should think about all three parts, because there are so many companies out there that actually have appalling governance but find their way into sustainable funds because of the E and the S. And it's E, S, and G, and we mustn't forget any part of it.
Richard, anything to add to?
Yeah, so from the financial advice perspective, even regulation have changed recently, which means that you have to ask clients if they have a preference where their money's being invested, if they have any ethical preferences, if they care about things like climate change, which wasn't the case. So now advisors are having to ask these questions, means companies are having to come up with solutions for some of the clients that do care about some of these issues, which is forcing money, I would say, down that route of the more sort of ESG aware companies and away from your sort of stereotypical fossil fuel and oil companies and things like this.
And asset managers can't hide anymore, which is a sort of good thing. There's transparency. It's very easy now to ask asset managers, you know, what do you hold? And whereas before you might, you know, once a year produce something and have a chat. There's virtually instant transparency, and that can go for the advisor or the institutional owner, and it can go to the you know, the woman in the street. They can look up very easily what a fund manager is doing. And if it doesn't align with what they think they should be doing, they can say something about that. So, I mean, that's one of the positive aspects of transparency in our industry, which actually reflects, to Mike's point, the kind of the G and the transparency across all of corporates. With where we've got, and with social media and everything else, it's very much harder to hide behind things that, you know, sophisticated accounting fraud aside, but these type of things are very much now within the fore, I think, for people.
I would add to that, though, that so many firms have cottoned onto this and are greenwashing their existing products. And you see time and time again, XYZ sustainability fund. It sounds great. You then look at the top 10, and 3 of them are fails on governance. And there's probably something in there that's a fossil fuels. And so I think we have to delve below the headlines. And I think ESG is something that you have to do for many, many years. It's something you learn by doing. And we see time and time again that that's the only way really to deliver a portfolio that investors increasingly want, that has the right companies rather than being greenwashed. So
Mike, to your point, are we looking at ESG from a risk management perspective, or are we looking at it from a value creation perspective as an analyst and portfolio manager?
I think it's shifted. I think previously it was much more from a risk perspective. What can go wrong? Whereas now it's being looked at much more as something that is aligned with underlying clients' values and is a way to deliver better returns as well. So I think there's been a morphing over the years, which is good.
Yeah, and I would add, I mean, particularly for us, what you could say is ESG opportunity or the ability to make being impactful on a positive basis in terms of both stock gains and stakeholder value is very, very important. It's not just about the ESG risks, but it's also about the opportunity. And you can see this reflected in companies. It's not all about just policies for trying to prevent bad stuff happening, but it's about innovation, incentive alignment, positive culture in order to also accelerate good stuff happening. And I think if you forget that we've also got to do the good stuff as well as avoid the bad stuff, then you're missing more than half the story.
Uh-huh. Richard, are you going to say something?
No, I was going to jump in. I think as well from the perspective of when we're talking to clients and when we're constructing portfolios, I think there's been a sort of shift in attitudes towards maybe 10 years ago when you're talking to people and they believed that if you went down this route, you'd actually miss out on returns. Whereas recently, I think people have changed their attitude and said, you can get just as good, sometimes better returns by adopting these policies. And it wouldn't necessarily be detraction from alpha if you stick to ESG policies, whereas that definitely wasn't the case 10 years ago. And people thought if you drop tobacco and oil and some of the big banks, then you just wouldn't get the same sort of returns.
Mm-hmm.
Yeah, I think that's one of the myths that we're still grappling with, which is maybe disappearing somewhat, but is still a little bit like, oh, are we going to lose money with this ESG thing, right? Which is definitely not the case. And in fact, to Richard's point and to what Mike and I were saying, is there's actually an opportunity to outperform using some of these techniques and tools.
Fantastic. I want to bring in a question posted by one of our audience here. So the question reads, to what extent are managers and companies looking at and evaluating both the company processes, policies, supply chains, and governance, known as ESG, with output and impact of their products and services, known as impact?
Let me take that. I think we've talked about how ESG differs and has changed over time, and we need to throw in impact into that as well. But when we're analysing a company, we analyse the whole chain. So we not only meet with management face to face, we find that as well as desk-based research is the best way to really assess a company. And we have our own internal proprietary rating system, which we follow, A, B, C, and fail. And companies like Alibaba, Samsung are fails on that. We also look at competitors, we visit stores, we try and analyze the supply chain as much as we're able. So we try and do as much as possible. Now, with any type of investment, nothing is foolproof. But with ESG, it is reducing those risks of something going on from the non-financial side as well. And then when we come on to impact, we're not the firm that would own a renewable energy company in India because it's a renewable energy company. For us, it's about those returns. Where we get the impact, however, is that we donate 10% of our firm-wide revenues to microfinance empowerment projects in the areas that we work in. So it's not part of the fund, it comes at a firm level, and that has a direct impact on the environment, on creating employment opportunities. And so that makes our business pretty unique. You have the ESG, you have the returns, but also you're actually transforming people's lives on the ground. And we think that's a much better way than buying a listed renewable energy company, for example.
So I would add from what we do, so we look at those trade-offs in the same sort of way. We're looking for sort of where there's positive things, and in an integrated ESG fashion, unlike impact, which is only ever looking at the positive, we're weighing up things that you should avoid and things that you can do on the positive side. Where perhaps we're a little bit different is that we do a lot of what we would call active ownership or stewardship, and that's where we try and make a lot of our impact. So that's influencing management's thinking, where they may not have thought about climate change or being aligned on that in terms of their long-term strategy, because perhaps they're not such an intense sector. we would engage with them and say why it's important to our stakeholders and why that would align with what long-term value. And even we typically invest in companies which we already think are pretty strong and pretty good, but there is no perfect company, and like there's no perfect person or anything like that. So actively engaging with them, particularly to the point sort of Mike was making in the secondary equity market, you're not necessarily in primary capital, which would be like if you're putting money towards that, but you often can influence managements in companies via an active stewardship way, which can influence how they run their businesses. And in that way, you can actually be more impactful, even though you might not have the same sort of measurement impact as a sort of private asset small impact investment manager or project might be.
I think Ben brings in a really interesting point, actually, and more people should be doing that. And we know from our experience when we do the engagement in emerging markets, and we tend to be more in the small and mid-cap spectrum, we're often some of the first people to discuss ESG with the companies. And so whether that's their supply chain, the use of child labor, cleaner transportation options, you actually can have a real tangible impact on those companies. And I think impactful is exactly the right phrase. What we also do is look at the impact in terms of waste generation, water usage of our portfolio versus a passive product. So you can look at it and slice and dice it in many, many ways. But I would completely agree with Ben's approach. That is the way the industry is going. And as stewards of capital, that's what we should be doing.
Do you think, just to ask both of you that then, potentially you can make a greater impact as an asset manager? Because we've spoke to a lot when we're choosing funds, we obviously speak to the managers in quite a lot of detail about how they approach stewardship. Do you think that you can make a bigger difference by investing in companies that have pretty poor ESG ratings and engaging with them and then making them better than you could potentially investing in companies that are already quite highly rated on the ESG scales?
I think there's a mix, and there has to be a minimum threshold. If it's poor, that we will not invest. If it's a C, and a C going to a B, going to an A on our rating system, that's where we've seen some of our strongest returns over the last few years. And to give you one example, there was an Indian retailer, and their procedures for ensuring their supply chain didn't involve any child labor were weak. And we engaged with them before we invested, and they improved those dramatically over time to something that was acceptable, that we saw as industry standard in Asia. And as other people have realized that this is a sign of management's beliefs, and it's not just about the numbers, it's about how management are aligned with us and our stakeholders, we've seen that company re-rate significantly. Another example just recently was in China, where one of the companies didn't produce sufficient emissions data. And we compared it to its peers and said, look, they can do it, so why can't you? And they actually said to us last week that they've now started publishing it due to the pressure they got from us and other people. Sorry, Ben, I sort of jumped in before you got there.
No worries. I'd add to what you were saying. So we tend to invest in companies which are already pretty good in many respects. But there are two ways of looking at this. And, your analogy, my analogy would maybe be with an athlete or a sports team, right? You can take someone like Usain Bolt, who's already the fastest person in the world, but you can still make him better. You can have coaches and things and active stewardship in the areas where he's a little bit weak. Or you can take me, who is definitely not running 100 meters in sub 10 seconds. I think I'd be lucky to do 20 seconds. And you can do a lot of improvement over various ways of where they're doing. And so you can do both areas of improvement. You can take a below average company to average and beyond and create value that way. Or you can take a company which is already good in many respects, but actually make them better. And actually, there's some studies which have come out which showing both forms of active engagement can lead to long-term stock price appreciation. The key thing, though, is that you're working on a material extra financial factor. So you don't want to say work on water stress for maybe a financial services company where water stress isn't really necessarily that material for them, but water stress for a drinks company which has got, for instance, manufacturing in sub-Saharan Africa, that would be an extremely material thing which may be something that you might want to work on. Whereas for financial services, it might be human capital management, employee engagement, and the like. And so that materiality, which partly answers someone's question about how large cap and small cap and other companies do it, that's the lens that a lot of people talk about, is what is really sort of business critical to that company, and you want to work on those areas, and you probably want to work less on areas which are not so sort of material or mission critical to where they might add value.
Again, I'm finding myself agreeing a lot with Ben. We have 13 key progress indicators that are our bespoke indicators, and some of those are red flags. And taking water, we want all our companies to produce data on their water usage. But if you're a beverage company, then if you don't do that, we won't invest, full stop. If you're a bank, you're absolutely right. It doesn't matter as much. And so we engage to promote that, but it wouldn't stop us investing. You know, a whistleblowing policy, if a bank, particularly a bank in a frontier market, didn't have that, we would worry about that much more than a consumer company in Taiwan, for example. So that materiality is absolutely key. And what we find is ESG cannot be a box ticking exercise. You have to really delve down, and each company has to be assessed on its own merits. There isn't one size fits all.
So that brings me right into the next question, which is the data. And I think that we've sort of, touched on it on the previous, section there, but perhaps we want to go a bit deeper into, the stage where we're at, where every company would have its own metrics, for example, to analyze stocks and analyze companies and highlight their ESG positiveness or negativeness. And then you have data providers who are pushing analysts like yourself and portfolio managers perhaps in one certain way, but it might not fit with your beliefs and with your philosophy. How are we, overcoming this challenge, because there's no homogeneous way of looking at this companies from that ESG perspective? Should we start with you then?
Yeah, so I put a little link into one of the questions about a sort of paper that we've done on this. So briefly, I would differentiate between the ESG data providers and ESG ratings providers. So the data is one thing and the ratings are another. And I would actually say that in some ways you can talk about the low correlation between ESG rating providers in a positive fashion if you think of them much more like sell-side or investment broker research, right? If a broker says sell on company X, I don't think any portfolio manager worth their salt immediately goes and says, oh, that's definitely a sell, and what that investment broker thinks is, is the gospel truth. And that's very much the same with ESG rating providers. They're not like credit ratings where there is a relatively high degree of correlation. They're much more like an opinion. And in fact, there is actually a little bit of analogy even with accounting standards. So people think that cash is cash, right? But actually, if you go cash and cash equivalents and change from IFRS to US GAAP to even Japanese GAAP, you can have a swing of billions of dollars. And I don't know of any CFO who doesn't try and convince me that adjusted EPS is the measurement that you should look at rather than something like GAAP EPS. And then in that same way, when you're talking about material issues on a lot of these kind of ESG things, that is where you still need an analyst, people like, Mike, Richard, and myself to look at, well, is this really what we think of as material? Do we try to trust this? Is this something which is going to be adding value or not to that? And I think if you look at it through that lens, the fact that you've got disagreements on ESG rating providers, although that makes it harder for us, say, on the financial advice side, because you can't just use a simple kite mark, okay, this is AAA, this is definitely the company that we should invest in. It actually makes the market a healthier place because it allows you to scrutinize, well, do we really think this is material? Check these assumptions, and do we think these assumptions are correct? Because we know oftentimes they're incorrect. My last point on this is actually in the last financial crisis, when we were looking at mortgage-backed securities, it would have been a much stronger signal had those rating agencies disagreed, right? Had one of them said it was AAA and one of them said it's CCC, the analysts would have gone back and gone, okay, let's go and see what's going on here. And in that way, actually, ESG rating providers, when they can disagree, and they have different methodologies and they're using different things, should really catalyze analysts to go, okay, is something going on here with Wirecard? Is something going on here with Boohoo or something like that to really understand what's going on and not just use, you can't really sum up any company with one letter score, and to kind of think that that is the case would be misleading. So this push and takes with that, I think it's going to get better, but really addressing the issue is by doing deep fundamental analysis on the issues.
So do you think there's a danger then so one of the problems I've heard numerous times is that with ESG ratings providers is that they can be quite uncorrelated and therefore, as you said, give different opinions. One of the things that potentially could be better is that they all start to converge on similar opinions. But do you think that could be a danger to the ESG?
Yeah, so I think it would be a dinner. I think, you know, I like diversity of where it's diversity of opinion. So the problem is if an ESG rating provider comes across as a fact, right? Like, you know, previously talking about a German autos maker, it seemed to be a fact that a lot of the ESG ratings were scoring it very highly. And to Mike's point, you know, the G or the something else might be very different. If it is actually an opinion and that opinion is wrong, the fact that you think it's a truth will mislead you. And I think in a lot of these things where we're talking about human capital, natural capital, all of these type of areas, there aren't any facts. There are actually a lot of judgments. And because ESG ratings providers have to go a lot on policy and a lot on tick box and a lot on what's disclosed, and a lot of it's on the focus is on the risk side. So it doesn't think about the positive side. It doesn't think about innovation, incentives, and culture, nor do they capture what we would call second order effects, which what markets are all about. So unintended consequences of policy, areas of emission where you're not investing in the future, and areas of like that. A lot of that is missed by ESG rating agencies by their nature, and they would be themselves the first to talk about this. It's the same with the proxy advice market, right? With this is with proxy votes. They are not a fact, but they are an opinion. And I think the more that we would use them as opinions, and the fact that this is still early days about where we're going, would actually, my flip would be the positive. And the day that we can say something as complicated as human capital or even sustainability and say, okay, 97 out of 100 points and all of these three agencies agree, and that is how we're going to do our ESG assessment, that actually would be very negative in terms of where you're going to get in terms of the market. And I think to Lydia's point in the beginning, then you would actually probably have a market failure in terms of where you would allocate capital, because there wouldn't be enough proper assessment about where something would happen. And we've already seen what happens when you don't have enough proper assessment on the underlying asset base, is what we saw in the last financial crisis. So kind of almost conversely, I think it's quite good that ESG rating agencies as an opinion are not necessarily coming to all the same conclusion and are nudging us to do proper investigation about where some of these issues are, because there isn't going to be a settled truth on it. And that is what's actually going to make a positive market, and hopefully will catalyze much better long-term wealth value creation for all stakeholders involved, rather than what Mike was referring to, the greenwashing, where you have 101 policies and you tick all of those boxes and we call that great ESG. Well, that might be a component of running your company well, but that's certainly not necessarily ticking everything you might want in terms of human capital, natural capital management, incentives, all of those material extra financial issues, which are the really important things for long-term value creation.
I would agree with the analysis of the problem. I have a slightly different solution what we do at Alquity. The rating agencies, I agree with everything that Ben said, but rather than trying to make the best of the bad job, we went a different route and we created our own processes. And so we integrate ESG at every stage of the process. We have our own grading system analyzed by us. We don't outsource it. We then also have our KPIs and our engagement strategy on top of that. And we think that gives you a much better and clearer method. Why would you outsource the making of a decision of an investment as an investment manager to someone else? So don't outsource the ESG, which is as if not more important. So we prefer to go the internal route, and the best person to assess the quality of a company is the same person who's making that assessment, whether to buy or sell it, or based on valuations, balance sheets, etc. But then I add an extra element to that, is that fund managers should have the lens turned back on themselves and be assessed for their ESG process, which again avoids the greenwashing problem. And people like label ISR in France is a great way to actually see whether the fund manager is really practicing what they're preaching or putting a superficial spin onto something else. And so I split it two ways.
So I'd agree on a lot of that. So we ourselves, the portfolio manager, do all of that integrated ESG assessment, bake it into our valuations, and then go on to do our engagement as well. So we don't outsource any of the ESG, or we don't outsource any of the engagement. I am still a little bit wary about labels. I mean, we have a whole bunch ourselves assessed by consultants and the like, and they give you a little bit of a flavor, particularly for Richard, for the job you're doing. But I don't actually think that negates the due diligence that I think you can do by speaking to a manager and really assessing how that might align with some of your own individual clients and stakeholders. The label gives you a kind of a flavor, but I would still say there is still value in actually the kind of work that you do.
So that brings me back nicely to the next question and going a bit deeper into portfolio management. And I've read about different ways that people or analysts and portfolio managers combine the sectors, the individual sectors, so E, S, and G, to create their ESG portfolio. Now, I know for sure, Mike, and obviously, Ben, you've talked about using the ESG integration approach, right? And I guess let's try and do some comparisons here. So if we were, as a portfolio manager or an analyst, if you're looking at, company valuation in the future, your fundamental analysis is pure key, and that is what is going to drive your potential alpha. Now you've got the ESG aspect of that as well. So I guess the question is twofold, which is, how would you combine your fundamental analysis with the ESG rate? And I think we've covered a bit of that in the earlier question, sessions, but perhaps going back on that a little bit more would be useful. And then lastly, how do you combine the ESG section, the S and the G section to create your own ESG portfolio? Who would want to go first, Mike or Ben?
I'll go first this time.
Right.
So on the first part, again, ESG has to be fully integrated in every stage of your process. It can't just be a filter. It has to have some sort of rating. It has to feed directly into the valuations, and then you have to have the engagement and the impact as well. So the way we do it is that our valuations are DCF based, and for companies that are A rated, we reduce the risk premium by 50 basis points. And for those that are C rated, we increase the risk premium by 50 basis points. Now, you can argue whether it should be 50, 60, whatever, but it does reflect those higher or lower ESG risks. Then on top of that, where there's a company that's going to perhaps struggle with the transition to a zero carbon economy, such as a motorbike company in India, for example, we then further increase the risk premium to reflect that higher risk of that company over the next 5 or 10 years as the world changes. So again, I think anyone who talks about ESG, you have to factor in that ESG into your valuation in some way. And then the second part of the question is E, S, or G, which is more important. And I think you have to take every company as it comes. One size doesn't fit all. And for some companies, the supply chain and do they use conflict minerals is the key thing. Another company in a different location will be renewable energy or water. Companies love to say how many independent directors do they have on the board. That's great. But do they actually turn up at board meetings? That's perhaps a deeper question. And every company is different. And so you look at all the different components, you put that company in the context of its country, region, and industry. And then with 10, 15, 20 years experience, you then make a judgment in the round on the ESG, combine that with a financial analysis, and that goes into your portfolio construction.
Great. I would add, so I've written a chapter on this for the CFA UK on the ESG investing certificate. There's also a video on the CFA UK conference talking about this, which you can Google on YouTube. I put it to one of the questions. So there are 4 or 5 kind of valid and established techniques here, and the one Mike talks about is definitely used. So I'll talk about my team rather than sort of all of the techniques out there. So we have some similarities. So we assess all of this ESG into a rating on the strength of the competitive dynamics and strengths of the company and all of that on assessment. And then we bake it into our valuation, and we use DCS and DCF scenarios as well as financial ratios. but we don't like to change the discount rates. So the pros of the discount rate, sort of Mike was talking about. The disadvantage of the discount rate method is that something like 50 bips, say plus or minus, or 30 or 70, is hard to actually say, well, what is the ESG premium on that? Why use 20 bips? Why use 30 bips? I mean, this is part of the problem about trying to calculate any cost of equity or anything like that. And for those of you on the call who's ever done a DCF, you kind of know you can get your DCF model to say anything you like, right? If you want to tweak growth rates and terminal growth rates, which is one of the things you learn as a sort of training analyst. So what we prefer to do is, rather than just the discount rate, is we prefer to embed those material factors straight into how we think sales or margins or direct things in the cash flow adjust. So if you're saying this company has got much better human capital management, then in year 5, if you don't think its sales growth will be better than the industry average, then 1 or 2 of those assumptions has to be wrong, say simplistically talking about it. So we directly embed that into our models for doing that, which then answers our second part of the question, which is similar to Mike, is where we look for, and this is the whole process is called a kind of materiality mapping, which again you can read about, and there's various techniques, but the portfolio manager is deciding what are the material ESG, all of the extra financial factors, and then in terms of what's material, we're baking that in directly into where our DCF model is going. So rather than getting the discount rate, it's exactly what it is. And that, to Mike's point, varies by company, sector by sector, and it also varies to the positive and as well as to the negative. And we put all of those elements of the extra financial capitals within that. A couple of other techniques just to highlight is some people do this on the ratio analysis, which again, we don't favor, but you could do that similarly. You could, say, oh, it's a 50% premium on X ratio. It should be an 80% premium on X ratio. Those are also valid techniques as well. Some people adjust to terminal growth rate instead as well. That's one way of doing it in valuation. And there's a whole bunch of other techniques. There's no one kind of settled technique on doing that, and all of them have their various pros and cons. And the important principle, though, is that you're trying to embed some ideas of these extra financials eventually into your financial model, because long-term cash flows are what we think are still driving stocks. There is also a quantitative way of trying to do this in terms of factor analysis, which I won't touch upon there. But if you're interested in the quant ways of doing that, there are different techniques that they try and embed. But a lot of practitioners are deeply arguing about whether they work, whether they don't work, and what the correct approach might be.
Does the size of the company matter at all? So would you say analysis for a large company, small cap, mid cap?
So they vary across 3 or 4 different dimensions. So to talk about quant, right, company size is one thing that you might look in terms of a factor. When you're talking about policies, we know that small companies have got less resources, so they tend to not have as many policies as, say, large companies. And that affects some of the ESG ratings, which use their stuff on policy-based and policy-based items. But when you're kind of doing fundamental analysis, then size of company affects how you're running your business model and things like that. So it is something to take into account. Is generally not size per se, but some of the second order effects that you have from being a smaller company. But again, different techniques, have different things various on that. It's definitely something you should take into account, because the likes of a very large consumer company will have very, very different resources to the likes of a smaller company, which might reflect in that. And, to the point that Mike said, in terms of a lot of emerging market stuff there, smaller companies or in things like that will have a very different lens that you might want to look at it. I don't know if Mike or Richard, you might have something to add on that.
Do you want to go, Mike?
Thanks, Richard. So I would agree with that. I think on the engagement, on the impact side, though, you can have a much greater impact on those smaller companies in emerging and frontier markets. Something like Taiwan Semi, which is one of the largest companies in Asia, is an A on our rating system. And they produce a lot of disclosure. There's areas of engagement we think they can do better, but they're very good. A smaller company that doesn't perhaps understand what best practice looks like in the region, through meeting with them twice a year, you can help influence them. And so I think in addition to everything Ben said, I think that's something to consider when we're talking about ESG and impact. Sorry, Richard.
I was going to say, obviously, it's really good to see how Ben and Mike are integrating their ESG into their analysis. On the opposite end, I have come across sort of fund managers before, or fund houses, where it's a separated process, and the analysts and the portfolio managers don't necessarily have much to do with the ESG analysis at all. So they do their financial analysis, and a separate team then comes in and says this is a good ESG stock or this is a bad ESG stock. And from our perspective, when we're looking at funds, that is certainly not what we're looking for, because I think if the analysts and the portfolio managers don't understand the risks and opportunities from the ESG side, then they're not really analysing the company properly, and they're definitely going to miss things. And what may look good from a financial perspective, from the balance sheets and the income statements, could be completely negated, or vice versa, completely made a lot better by the ESG side. So certainly from what we're looking for, it's really good to see that the integration of the ESG rather than a separated team. And even if that team is really experienced and got some really good sort of knowledge behind them, and what they're doing is really good analysis, if it's a separated process, it's generally I've found like not as good as a management way for the fund.
So Richard, I want to come to you right now. So you've mentioned some of the things that you want to see, from portfolio managers and analysts when they're doing their stock selection. What else do you want to see from portfolio managers if they're focused on ESG equity investors?
So we have sort of discussed.
We're all interested in that answer.
So just them saying nice things to me.
Yeah.
I think we've already touched on quite a lot of it. So ESG integration is really important, and the different methods of adjusting discount rates or growth rates or expected revenue. I don't really mind as long as it works which method is being used. What we're really looking for is that it's being taken seriously, it's being integrated into the analysis, as opposed to a separated point, as I just spoke about. The other thing I personally think is really important is the stewardship side, because I think, especially as assets are being moved into ESG vehicles and products, I think the asset managers have a lot more power to change companies. And I know in different areas, and when you meet managers from different regions, it can be a lot more difficult. I know sort of the US definitely aren't as open to engagement as Europe are, and Japan, although Japan have obviously made some changes in recent years, but there's certain, you've got to sort of allow for differences in different regions and different asset classes, etc. But certainly the stewardship side is really important. And I quite like to talk to the managers and analysts quite a lot about how they do that. And again, some asset managers have stewardship teams that specifically go out and talk to all of the companies on certain issues. But it's nice to see, even if that's the case, that the analysts and the portfolio managers are involved in those discussions. So if there is a stewardship team going to meet a company about a particular issue, that the analysts and the portfolio managers are at least involved in that discussion, as opposed to being completely separated and leaving the voting and everything to the team that deals with it. And generally it happens with quite a lot of the bigger asset managers, and you can see why, because they own thousands of companies, and that it makes sort of sense from an efficiency perspective to have those teams. And it's also quite good to hear when the asset managers are looking to team up with other asset managers to really have a bigger impact, and when they're talking to companies, especially if their holding might be quite small, quite a small percentage of the overall holding, and they're getting together to really say that this is an important issue for us. And I think the last thing is that the sort of sustainability in returns, and the fact that it's still an investment. You still want to make sure that the investment's going to make money in the long run. And importantly, like, if the company's doing the best thing in the world, that's great. But if that's not sustainable, and in 5 years they're not going to exist as a company, then that impact's going to be very limited. So under all of this, it's still important to see that that you believe that the philosophy of that fund is going to allow for good returns over the long run.
Are there any red flags you looked at? Because I think you looked at collaboration, stewardship, integration, done by the portfolio manager, philosophy, which makes sense. Are there any red flags if you kind of see that? One that I've seen, which I guess is an obvious one, if they've just rebadged a fund, that's obviously a bad news. Like, it was called whatever, and now it's called sustainable, and there was obviously no change. Yeah. But I was wondering if there's any other trends that you see, and you kind of raise your eyebrows and goes, well, that's a good bit of greenwash, but I'm not convinced there.
So I think one of the things is, I don't mind if it's if it's quite honest about what they're doing. So if it's a fund and they've said we've got an ethical version of this fund, and what we've done is we've screened out all of the stocks from these sectors or these industries, and they talk you through their screening process. If they say if what they're doing is what they say and they're not pretending to be anything else, that's fine. But if people are pretending it's a sustainability fund and really all that's happening is they've screened out
tobacco or whatever,
then and really the big one for me is if it is the integration of the engagement and the ESG analysis, is that if the portfolio managers, if you're talking to them, the fund managers and portfolio managers, and they don't really know about the ESG stuff, and their sort of view is, well, I don't need to. I've got, this great team that do it all for me. You're like, well, you do need to. More than anything, that should be, a really main function of your job. And I think that's a big warning sign.
And not that we're going to hammer many of our competitors, but were you saying that some of the larger asset management houses have that just because of the nature, but it's the nature of having to look after a lot of companies. So there's a kind of structural issue around that.
But I don't mind it. So some of the larger asset managers have some quite good stewardship teams and engagement teams. And I don't think there's anything wrong with that, as long as the analysts and the portfolio managers are involved in the process. So if they at least attend the meetings with them where possible, and they're involved in what they think should happen on a specific issue, or if there's a vote that could be a little controversial, generally it's going to be about board remuneration or something. But if there is a vote that the portfolio manager wants to vote against, or the stewardship team wants to vote against, then I think it's important that they at least discuss that so they're both on the same page. Because you can get, obviously with some of the big asset managers, if they've got a sustainability fund and then they have a different fund that doesn't have any sort of mandate in that respect, they could have two portfolio managers wanted to vote in different ways from the same asset manager on the same company. And obviously that's quite difficult to deal with. And I think it's good to see when the asset manager says, well, actually, we let the portfolio manager decide that vote and it's not decided centrally, because then it at least gives some freedom for the manager of the fund to do what they think is right for their mandate. But that becomes quite difficult when you've got almost contradicting opinions. And it's not that surprising when you have asset managers with hundreds of funds that two portfolio managers might think completely different things.
I've got one final question here to ask the whole panel, but before I get onto that, I want to sort of conclude a thought with Richard. I know you recently launched your responsible portfolio earlier on this year. So I'm quite interested to know how you're optimizing that portfolio. Are you doing by themes, or are you some of the stuff that you mentioned earlier on? How are you combining fund managers within that portfolio?
So the way we approached it is we wanted the portfolios to be appealing to most of our clients, because if you take the view that there is that there should be now you should get the same returns from an ESG tilted portfolio, sometimes better in the long run, then and you've got one portfolio that's a responsible investment portfolio that should be doing better for the world and one that isn't. Well, if you're going to get the same returns and one's doing good and one isn't, then it should be quite a straightforward choice. You're going to choose the one that's going to do good. So what we want to do is construct the portfolios in a very similar manner to our standard portfolios, specifically with the asset allocation side. This for two reasons, really. One, so that clients can see that the portfolio, if they wanted to switch from the standard to the responsible models, the portfolio would look very similar. And secondly, from the financial planning perspective, so that the advisors themselves, when it comes to things like cash flow planning, risk return profiles, should be able to apply the same risk return profiles, etc., for the RI portfolios than for the standard portfolios, which should help them in financial planning over the long run. So what we basically did is we started with our asset allocation, and then we tried to fill that asset allocation with responsible funds. And where possible, we'd use impact funds, and then where they weren't available, we'd use sustainable funds, and then going down to ESG and ethical funds. It does get quite difficult in certain areas because there aren't the breadth of funds in the sort of responsible investment world as there are outside of it. And you can be, obviously in a standard portfolio, there's all sorts of funds. But what there are more thematic funds. So obviously you're not going to have a commodities fund, but there's renewable energy funds. We didn't have, you take out our financials fund, but you can add in a different theme, like we've got a fund that's trying to combat CO2 emissions, and a fund, smart city fund, which is trying to make cities safer, healthier and less pollutive, instead of an infrastructure fund. So there are options and alternatives, but what we try to do really is make the portfolios as a whole look very similar to the standard portfolios, and that's the approach we took, not to take a specific thematic theme like climate change and center the fund around that. And I think that's mainly because we can still do that for individual clients on a bespoke basis. But what we want to do is try and appeal to the masses so that we can get a lot more money aimed towards these sustainable portfolios, rather than trying to be quite specific and turning off a lot of people.
Mm-hmm. Well, thanks very much for sharing that. Now on to the burning question for everybody. I'll read it as follows. There is a general consensus that life might be about to get harder as COVID-19 causes economic havoc globally. Further, the ongoing US-China trade war is challenging many industries, pricing, supply chains, and ultimately people's lives. So if we have a challenge here from increased unemployment, structural change in various industries, namely commercial property, restaurants, transport, manufacturing, etc., then in this situation, will the average person's interest in ESG considerations increase, or is there a chance that it becomes a lower priority as people look to just get by? So right now, it all looks positive, of course. So what are your thoughts as to what might happen in the near future? Who wants to go first?
I can.
You go on, Mike.
Thanks.
You go.
Okay. So I think the answer is no. ESG will become increasingly important year after year after year. And just recent scandals like Wirecard, Boohoo, Luckin Coffee in America just demonstrate the importance of not just looking at financial factors, but looking at the governance and the social impact as well. And I think this isn't a fad. I think that people thought that maybe 5 or 6 years ago with ESG, but it's mainstream and it's here to stay. The world is a difficult place. We see risks of recession in the West. We see increased political risk in China, but you are able to find companies in emerging markets that benefit from still structural growth themes, sustainable competitive advantages, not impacted by global geopolitics, and also have excellent and improving ESG. So we see more and more demand from clients for this kind of product. And I think it's just common sense. It's been badged as ESG and all very new and exciting. Why wouldn't you want to invest in a company that is one of the best run, that really take care of their staff, that take care of the environment? It lowers the risk and gives you as good or better return over the longer term.
So I have a nuance to add to that. So while I agree that this, call it ESG extra financial blob, has always been with us, right? We've always wanted companies which add long-term value and wealth creation, all of this, whether we call it ESG or not. I do think that if you think of markets as a reflection of human society, humans always have this pull between the short term and the long term. And I do think there's various aspects where that tension will become in focus. So for instance, has anyone really heard from Greta Thunberg in the last 6 months? No, that has come slightly down the pecking order as people have rightly concentrated on COVID and something like that. And so these thinkings, and we've always got this trade-off, which you can most easily see in time horizon, but you might see in other things between, say, health and the environment and things like that. And to that extent, that the priorities may shift around in this, and that there is a risk that some long-term investments that we should be continuing to make might not go the way that you might think. You might see some of this with like, oh, are we going to go heavy on coal because that might have a short-term business impact versus a long-term natural capital. So to the extent that the question is asking, are we going to think about some of these trade-offs, then I think that will get heightened. But then I think it is beholden on us in our stewardship and in our influential voices to say, take the UK as an example, where we're thinking about stimulus. And let's not forget that green infrastructure could have really high returns. Let's not think about the human capital side of the business. In a hurry to restart everything, we should also need to think about the long term as well as the short term. And in that sense, I don't think that tension between short term and long term, of which ESG is a thing, will ever go away. And I don't think we should necessarily be complacent that some of those long-term investment challenges aren't going to remain with us. And I think there's already signs that question is happening on the climate lens. And there are these other challenges which will come up, right? Black Lives Matter, gender pay gap, society changes within that. The challenges of 50 years, 100 years ago may morph and change, but they're likely still with us. So it's a kind of yes and no on that.
I would agree with Ben identifying that risk. I think I'd respond in two ways. Firstly, we run very focused portfolios, and if companies do backslide, then we just divest. And there are enough great companies that aren't going to make the wrong choice in that trade-off that are good candidates for our clients' capital. And secondly, I think that we speak to about 90 companies every month, and we've not seen a single example of anyone going down that route. Now, obviously, it's a very biased sample size, but it's actually the other way. And the S part of ESG has actually gained prominence over the last few months, not just in terms of ensuring that staff are adequately protected, but also thinking about how customers can interact with the company in a safe way. So I completely agree there's a risk. Certainly not seeing that yet, though we're alive to it. And actually, I'd say the opposite for the time being.
Also, from the portfolio perspective, our ESG portfolios outperformed our standard ones during the crisis. So if anything, it strengthened the view that there's a lot of risk mitigation by holding ESG stocks. So suddenly, to the advisors in the company that maybe didn't look at them in that much detail, suddenly they're considering them. So I think from an investor perspective, as in from the sort of end client, I think COVID-19 might have actually caused people to look at ESG portfolios more than they did beforehand.
Well, we're just coming up to the hour, and I promise people that this is going to be a maximum 1 hour conversation. But I think all your insights have been very, very useful. I've learned a lot by speaking with you, Ben, Mike, and Richard, around obviously company analysis, portfolio construction, from your individual portfolio perspective and strategy perspective, but also from a multi-manager perspective. So thank you so much for sharing your thoughts. It has been wonderful speaking with you. Thank you. And we'll be sharing the videos later on LinkedIn. We will encourage you to, play back to the discussions that have been held today. Thank you so much. Have a wonderful week, and we hope to see you soon.
Yeah, thank you. If any of you would like to, or anyone in the webinar, reach out via LinkedIn for any more thoughts or details, please do. That's a good way of reaching out to me, and I'm sure the other participants too.
Yeah, definitely. Thank you.
Great. Thank you.
Thank you.
Thanks.
Bye.
Bye.